Ladies and gentlemen, somewhere in Washington this week, a quiet decision moved through the machinery of trade policy, and almost nobody outside the metals market noticed it happen. No headlines screamed about it. No cable news segment broke into regular programming. And yet, if you understand how monetary systems actually work, you already know that this is exactly how the important signals arrive. They don't arrive with sirens. They arrive quietly buried in a policy review, and by the time the crowd catches on, the smart money is already repositioned. What I want to walk you through today is not a prediction, and it is not a conspiracy theory. It is a chain of cause and effect built entirely on evidence that is publicly available to anyone willing to look for it. By the end of this video, you will understand why silver just went through one of the most violent price swings in its modern history, why the Trump administration's approach to critical minerals tariffs is more consequential than most investors realize, and why the answer to what happens next has less to do with silver itself and more to do with something far bigger, the credibility of money. Before we go further, I want to ask you something, because I think your answer says a lot about where we are in this cycle. Type it in the comments. Where are you watching from? And right now, are you holding gold, silver, or cash? I ask because the answer tends to cluster by region and by temperament. And watching how those answers shift over the coming months will tell us something about investor psychology that no chart can show us. Now let's get into it. To understand why silver matters right now, you have to start with a fact that surprises a lot of people the first time they hear it. Silver is not simply a shiny cousin of gold. It lives a double life. About half of global silver demand comes from industry, solar panels, electric vehicles, medical devices, and the vast web of electronics that depend on silver's unmatched conductivity. The other half of demand comes from investors and central banks who treat it the way they treat gold, as a store of value outside the banking system. This dual identity is the reason silver is more volatile than gold. When industrial demand shifts, silver moves. When monetary fear shifts, silver moves again, often harder and faster than gold, because the market for silver is smaller and thinner. A given dollar of buying or selling pressure moves silver's price more than the same dollar would move gold. That is not a flaw in silver. It is simply the mechanics of a smaller, more reflexive market. Now overlay onto that structure what has just happened in Washington. Earlier this year, the Trump administration launched what is known as a Section 232 review, a national security investigation under the Trade Expansion Act into whether the United States' reliance on imported processed critical minerals, silver among them, poses a strategic vulnerability. For a while, the market treated this as background noise. Then, in mid-January, when tariffs on these minerals looked imminent, silver spiked to an all-time high above $120 an ounce. Within days, the administration reversed course, holding off on the tariffs and instead directing trade officials to negotiate bilateral supply agreements and consider import price floors instead. Silver fell more than 7% in a single session. That kind of whiplash, a record high followed by a violent reversal within the same month, is not something a stable, mature market produces. It is something a market produces when it does not yet know what regime it is trading under. This is the part I want you to sit with, because it is the actual thesis of this video, and everything else builds toward it. Tariff headlines are not the disease, they are a symptom. The deeper condition is that the United States government is now running fiscal deficits so large and a debt load so heavy that trade policy itself has become a tool of monetary and fiscal management rather than simply a tool of trade. When the Supreme Court struck down the administration's emergency tariff authority earlier this year, independent analysts estimated the ruling would add roughly $2 trillion to the government's projected borrowing needs over the coming decade. Read that number again. $2 trillion is not a rounding error in a federal budget. It is larger than the entire annual economic output of most countries on Earth. When a government faces a fiscal hole of that size, it is only a small number of tools available to close it: raise taxes, cut spending, grow the economy faster than the debt, or quietly let the currency do some of the work through inflation. Historically, when the first three options are politically difficult, governments lean, whether they admit it or not, toward the fourth. This is where I need to walk you through some real economics, because the words inflation and debt get thrown around so casually in financial media that people stop hearing what they actually mean. A national debt is a promise to repay lenders in a specific currency at a specific future date. If a government can grow its economy faster than that debt accumulates, the debt burden shrinks relative to the size of the economy and everyone is fine. But if the debt grows faster than the economy for long enough, at some point the market for that government's bonds starts to demand a higher interest rate as compensation for the growing risk of holding that debt. Higher interest rates mean higher borrowing costs, which widen the deficit further, which requires more borrowing, which puts more upward pressure on rates. Economists call this a debt spiral, and it has ended governments and currencies throughout history, from Weimar Germany in the 1920s to Argentina multiple times across the 20th and 21st centuries, to more recent, milder versions of the same dynamic playing out in parts of Europe during the sovereign debt crisis of the early 2010s. I am not telling you the United States is on the verge of Weimar-style hyperinflation. That would be irresponsible and untrue. What I am telling you is that the mathematics of debt spirals are well understood, the warning signs are well documented, and several of those early warning signs, persistent deficits, political resistance to spending cuts, and a central bank under public pressure, are visibly present in the data right now. Whether they resolve gently or violently is genuinely uncertain, and anyone claiming certainty in either direction is selling you something. Let's talk about the Federal Reserve, because this is where the story gets more interesting than most commentary lets on. In May of this year, Kevin Walsh was sworn in as the 17th chair of the Federal Reserve. At its first meeting in mid-June, the committee held the federal funds rate steady at a range of 3.12 to 3.75%, a decision the market had almost entirely priced in beforehand. But it was what happened around that decision that mattered more than the decision itself. Chair Walsh chose to withhold his personal interest rate projection from the Fed's quarterly forecasting tool, known informally as the dot plot, becoming the first chair in over a decade to sit out that exercise. The committee itself was nearly split down the middle, with roughly half its members expecting at least one more rate hike before year end, and the other half expecting none. When the people responsible for setting the price of money cannot agree among themselves, and when the new chair declines to even offer a public forecast, the market loses one of its most important anchors, forward guidance. Financial markets do not simply price in what interest rates are today. They price in what investors expect rates to be in the future. Remove the clarity of that expectation, and every asset that is sensitive to interest rates, bonds, stocks, currencies, and yes, precious metals becomes harder to price with confidence. Uncertainty itself becomes a variable the market has to trade around, and historically, uncertainty about the reliability of central bank guidance has been one of the more reliable tailwinds for gold and silver. Here is the mechanism in plain terms for why interest rates matter so much to metals that pay no interest at all. Gold and silver generate no yield. They do not pay you a dividend or a coupon. So when interest rates are high, an investor holding a treasury bond earns real tangible income for the privilege of parking their money there, and that income is the opportunity cost of holding metal instead. When rates fall, or when investors lose confidence that the currency backing those bonds will hold its value, that opportunity cost shrinks or disappears, and metal becomes relatively more attractive. This is why the relationship between real interest rates, meaning the nominal rate minus inflation, and the price of gold and silver is one of the most consistently observed relationships in macroeconomics the past half century. It held during the stagflation of the 1970s. It held during the 2008 financial crisis and its aftermath, and it has held again through the volatility of 2026. Now, let's bring in the central banks themselves, because this is the piece of evidence that I think most retail investors have simply overlooked, and it is the single most important data point in this entire story. According to the World Gold Council, central banks around the world purchased an estimated 244 tons of gold in the first quarter of this year alone, a pace that exceeded both the prior quarter and their own 5-year average. China's central bank, the People's Bank of China, added nearly 15 tons of gold to its reserves in June, its largest single-month purchase since 2023, extending a buying streak that has now run for 20 consecutive months. Here is what makes this remarkable. China made that purchase during gold's worst quarterly price decline since the taper tantrum of 2013. In other words, the People's Bank of China was not chasing a rally. It was buying into weakness deliberately month after month through a correction that scared off a lot of short-term traders. Central banks do not behave like retail traders. They are not trying to catch a bounce or time a headline. Their reserve managers think in terms of decades, not days. And when you see sustained, disciplined accumulation through a price decline, that tells you something important about how sophisticated, long-horizon institutional capital views the asset, regardless of what the ticker is doing. This week, Poland and several other central banks have followed a similar pattern. part of a broader multi-year trend of nations diversifying their reserves away from an overwhelming reliance on the US dollar and US Treasury securities. Why would a central bank want to hold less of its reserves in dollars? This is where currency strength and geopolitics intersect with monetary policy in a way that is easy to explain but often gets lost in the noise. For 80 years, the US dollar has functioned as the world's primary reserve currency, the asset that other nations hold to settle trade, back their own currencies, and provide a stable store of value. That status is not permanent by law. It is earned and maintained through confidence. Confidence that U.S. institutions are stable, that U.S. debt will be honored, and that U.S. monetary policy will remain predictable and rules-based. Every time that confidence is tested, whether through political pressure on the central bank's independence, through legal battles over the constitutionality of major economic policy tools, or through erratic swings in trade policy, some fraction of the world's reserve managers quietly reallocates a little further toward assets that carry no counterparty risk at all. Gold and silver are unique in the financial system because they are nobody's liability. A bond is a promise from someone else to pay you back. A dollar in a bank account is a claim on an institution. Gold sitting in a vault is not a promise from anyone. It is simply there. That single property, freedom from counterparty risk, is why gold and silver have functioned as monetary assets for over 3,000 years of recorded history across empires, currencies, and political systems that no longer exist. I want to pause here and talk about something that rarely gets discussed in financial content, which is the actual biology behind how your brain processes moments like the one silver investors are living through right now. When you watch an asset you own fall 50% from its peak, as silver has done since January, your brain does not process that as a neutral data point. Neuroscience research on decision-making under uncertainty has consistently shown that the amygdala, the brain's threat detection center, activates strongly during financial losses, triggering the same fight or flight chemistry your ancestors used to escape predators. This is why panic selling near the bottom of a decline feels in the moment like the rational, safe choice. It isn't rational, it's biology. Meanwhile, the opposite bias kicks in during a rally. As an asset price rises, the brain's reward circuitry, driven largely by dopamine, reinforces the behavior of buying more right at the moment when price has already run furthest from underlying value. This is why so many retail investors buy euphorically near tops and sell in panic near bottoms, doing the exact opposite of what long-term evidence suggests they should do. Understanding this is not just academic. It is the single most practical piece of information I can give you in this entire video, because the investors who build real wealth across a full market cycle are almost without exception the ones who have trained themselves to recognize these biological signals for what they are, urges, not instructions, and to act deliberately rather than reflexively. Let me tell you about someone I'll call Daniel, a 34-year-old software engineer who started buying silver coins in late 2025 after watching prices climb for months. By January, when silver touched its all-time high above $120 an ounce, Daniel felt like a genius. He had turned a modest position into what looked on paper like a life-changing gain, and he told himself he would sell on the next leg up. There was no next leg up. Within weeks, tariff reversals and a stronger dollar dragged silver down sharply, and by the time Daniel finally sold out of fear rather than strategy in the aftermath of the Iran-related volatility in the spring, silver had fallen well below where he originally bought it. Daniel is a composite, a fictional character built to illustrate a pattern I want you to recognize, not a real event, but the pattern itself is drawn directly from decades of documented investor behavior. He did not have a plan for what he would do if the price fell. He only had a plan for what he would do if it kept rising. That asymmetry, a strategy that only works in one direction, is the single most common thread connecting investors who buy high and sell low across every asset class in every era. Now, contrast that with someone I'll call Maria, a 58-year-old small business owner who began allocating a portion of her savings to physical gold and silver back in 2022. Not because she was chasing a trend, but because she had read enough financial history to understand debt cycles and wanted a portion of her wealth that did not depend on any single government's promises. Maria never tried to time the market. She bought a fixed dollar amount every quarter regardless of price, a strategy economists call dollar cost averaging. When silver spiked in January of this year, she did not sell everything euphorically. When it crashed in the weeks after, she did not panic and liquidate. She simply kept her allocation steady treating the metal as insurance rather than as a trade. By the middle of this year, even with silver well off its highs, Maria's average cost basis across 4 years of steady buying left her comfortably in profit, and more importantly, psychologically unshaken by volatility that had wrecked less patient investors. Again, Maria's fictional, a composite built from patterns commonly described in behavioral finance research, not a documented case. But the lesson she represents is one of the oldest in investing. Time in the market applied with discipline tends to reward patience far more reliably than any attempt to predict the next headline. There's a third figure worth mentioning, a retired teacher I'll call Robert, 67 years old, who held nearly his entire retirement account in cash and short-term treasury bills throughout the volatility of the past year, believing this made him safe. In nominal terms, Robert's savings never fell in value. Not $1 disappeared from his account statement, but inflation data released throughout 2026 showed consumer prices running persistently above the Federal Reserve's 2% target, meaning the real inflation-adjusted purchasing power of Robert's cash was quietly eroding every single month, even as the number on his statement stayed the same or grew slightly from modest interest payments. This is the danger of cash that so few investors intuitively grasp. Nominal safety can coexist with real loss. Robert felt secure because his balance never dropped. He did not feel the erosion happening beneath the surface because, unlike a market crash, currency debasement does not announce itself with a dramatic red number on a screen. It happens quietly in the difference between what things cost this year and what they cost last year. Robert, too, is a fictional composite, but the mechanism he illustrates, the invisible tax of inflation on cash holdings, is one of the best documented phenomena in monetary economics going back to every fiat currency regime in modern history. If you're finding this useful, take a moment to hit like and subscribe because I want you to stay with me through the next section. Everything I've explained so far, the tariff volatility, the debt dynamics, the Fed's uncertainty, the central bank buying, the psychology of fear and greed, all of it is building toward one final insight that ties the entire picture together. And I promise you, it will change how you look at every gold and silver headline you read from this point forward. Let's return to where we started, the Section 232 review, and the idea of an import price floor on critical minerals like silver. On the surface, this looks like a narrow trade policy story, but step back and look at what a price floor actually represents. A government considering setting a minimum price for a strategically important commodity is a government acknowledging implicitly that it no longer fully trusts free market pricing to deliver a secure, stable supply of that material. That is a meaningful admission. It tells you that policymakers view certain physical commodities, minerals with industrial, defense, and technological applications as too important to leave entirely to market forces. Now, consider that the same government is simultaneously running the largest sustained peacetime deficits in its history, borrowing at a pace that recently added roughly $2 trillion to projected obligations in the span of a single court ruling, while a nearly evenly split central bank sits without a clear forecast for where interest rates go next. Put those pieces side by side, and you are looking at a government that is increasingly treating both physical commodities and its own currency as strategic instruments to be managed rather than simply letting markets set their value freely. Whenever that has happened throughout history, whether in the commodity price controls and gold buying restrictions of the 1970s, the currency interventions of various emerging markets over the decades, or the reserve diversification moves major economies are making again today, the practical result tends to be the same. Investors and institutions